In this module, we're going to give an overview of the dynamics of the private equity market, particularly from the point of view of assisting advisors to companies to better understand the perspective of the private equity fund manager so that they're more able to assist their clients. So that is the perspective that we're going to be applying in this module. And so in order to get this perspective, it's quite important to understand the context in which private equity fund managers operate, the competitive position of private equity funds with each other, the exit-driven requirement of private equity fund managers, and the approach they have to screening investments. So what we're going to aim to do in this module, we're going to try and satisfy several objectives. The first one is to give a little bit of the context, an overview of how the private equity market works and its background, its history. This is something that many people who do not work in private equity have absolutely no idea about, but it does have an important influence over how private equity fund managers behave and see their potential investments. So it's important to understand the context in which they operate. The next thing we're going to look at is what are the key requirements of venture capital and private equity investors, what are their key criteria, what are their main hot button topics, which can be addressed then by advisors to the company. Thirdly, in terms of the process, we're going to look at a little bit about the screening process of private equity investors. Private equity investors view screening as an important exercise. They see it as a labor-intensive exercise. We have to remember as an advisor to the company that a private equity operation is a capacity-constrained operation. The investment professionals have only so many hours in the day and so many days in the year, so they're going to be looking at their time budget when they screen an investment. So anything that's easy for them is going to attract more attention. We will start with the first section, which is an overview of the private equity ecosystem. So one of the first questions is, what does a private equity fund look like? Well, they're a little bit like the talent scouts of the corporate world. They're looking for companies with potential. And this can go from a startup, which is just an idea, to acquiring large companies which have fallen on hard times without an idea of making them better again. But the fact is, the vast majority of private equity, about 85%, is into medium-sized companies and is into what's known as growth investments, taking a medium-sized company which is already existing and making it better, making it into a market leader. And so the main question we want to ask ourselves is, what is it that makes a firm qualify for this very rare private equity investment? So what private equity funds look for is not potentially winners or market leaders. In fact, they're looking really for companies with potential, which allows them to get in somehow at the ground floor and help the companies realize this potential so that they can produce a winning company. And so they're a little bit like talent scouts looking for an undiscovered athlete. People often think that the private equity firms are these very large firms. There are a number of very large firms in the world, but they're a very small minority. Business School INSEAD estimates there's about 6,000 to 8,000 private equity firms globally, and only about 50 to 100 of these are large firms. The typical private equity fund is a group of 10 to 20 professionals managing an amount of money that could vary between 50 to 400 million. And this group is searching for some 10 to 15 companies to invest in over the life of their fund. Private equity, successful private equity, works extremely well. Many studies have shown that. And there's really two fundamental reasons. The first is that the fund manager has time. He is not under quarterly or annual earnings pressure. He has time to build the company out over the cycle, but is also focused because he has to eventually exit his investment after a number of years. So time is a medium time horizon, which allows you to do a lot more things than if you're looking more short term. And the second reason is that the private equity fund manager will only make money if he manages to increase the value of the company. And that is the only agenda that drives him, and that can be very powerful.
Question 1. What is the main role of the fund manager? A. To collect big salaries. B. To invest in a company and make it more valuable. C. To get big fees even though the company value was not increased.
Let's look at some of the jargon you might hear in private equity. So let's start with hedge funds. Hedge funds are really nothing to do with private equity. These are funds that invest in typically traded instruments. They might buy quoted stocks, they might buy bonds, commodities. So they basically are funds which we could consider as playing the markets. Private equity funds don't do that. They invest in private companies. And there's three types of private equity funds. There's the venture capital funds, which tend to look at younger companies, and we've obviously all heard of those from Silicon Valley. And then we have buyout funds, which are larger funds that will buy mature companies, often using leverage, and they've often been talked about on the media. And then the vast majority of other private equity funds, which is expansion capital, which is where they take a company that already has a position in the market and take it to the next level. Let's compare the private equity market to other asset classes, such as hedge funds or government bonds or blue chip shares, quoted shares. The key features are the following. Firstly, private equity hasn't been around all that long. It only really got going in a major way probably sometime in the 1980s. So it's a young market. The asset class is quite new. Secondly, it's growing. The market has grown a lot. It did have a hiccup in the same way as other markets did in the great crisis of 2008 or 9, but the growth in private equity markets has been steady over the years. Thirdly, it's the most difficult market to get information about because ultimately it's not a regulated market, and the only person who really knows what's going on in a private equity fund is the manager of that fund. And so information is harder to come by than information on public markets. Fourthly, performance. Private equity funds, it's a little bit of a feast and famine. Very good fund managers do extremely well, whereas poor fund managers do extremely badly. So the dispersion of the returns according to the different fund is extremely high compared to other types of funds, such as mutual funds that invest in blue chip shares, for example. Emerging markets, which represent about 20% of the global private equity market, have benefited very strongly from private equity due to the fact that private equity investment has a major developmental impact in those countries, drives entrepreneurship, access to finance, and quality jobs. Finally, what we've seen in recent years is the growth of impact investment. And so this is a type of investment thesis which has a dual objective, both to earn a return on the capital, but also to do social good. And this is known as impact investment. And some of the private equity that we see is, in fact, a version of impact investment. The PE market does have a certain history. I think we could probably trace it back to the UK and the US. In the UK, we saw the formation of Charterhouse and 3i, which was done after the Second World War, and they were there to try and provide more finance for middle-sized enterprises. In the US, we saw the formation of American Research and Development Corporation, which then led on to Silicon Valley. So Silicon Valley is actually a descendant of an American government institution. Some early examples of private equity companies was Apple, Federal Express, and others, but it really remained something of a cottage industry. And then in the 1970s, it started to develop somewhat. And the big development was in the 1980s, where the so-called leveraged buyout funds started to emerge, the most famous one being obviously KKR. And what happened there is that these funds noticed that a lot of the large American conglomerates were not very well managed, and there was an opportunity to buy them out and break them up. The second big impetus for the growth of the private equity market was then in the 1990s, and that was created by the internet and by mobile telephony and the other technologies related to that. And that gave a huge kick to the market in terms of the innovation and growth in certain sectors like telecoms and others. The market peaked at about 500 billion a year in 2007, and then is now settled down to something like 250 billion or so per year. The history in emerging markets is a little bit different because this happened more in the 1980s. The development banks such as IFC, EBRD and others saw that private equity has a major impact in terms of jobs, in terms of helping companies develop, and they decided that they would try and promote this model of development into emerging markets. Hence the major role played by international financial institutions in the emerging markets, private equity. Like any asset market, the private equity market has its structure and its players. At the bottom of it, we have specific investments. In other words, companies that have received private equity investments, or projects perhaps, such as infrastructure projects, which have also received such an investment. At the center of it, if we will, are the fund managers. These are the people who ultimately make the decisions of how to allocate the capital that they've collected and to which companies and on what conditions. And these are the fund managers, who we could then subdivide into the four categories of funds, which are buyout, expansion, venture, and mezzanine funds, which invest through debt. Who is the person putting the money into the fund managers? Well, these are the asset allocators. So these will include pension funds, insurance companies, banks, university endowments, family offices, and developmental financial institutions, as well as other entities, including private individuals. In order to facilitate this market, we have the so-called multi-managers. So we have funds who collect money from these asset allocators and who specialize not in making investments themselves, but in investing in fund managers. So they're known as funds of funds because they invest in fund managers. We also have secondaries funds who buy out positions of funds where the asset allocator wishes to withdraw from a fund. And then we have an industry of consultants, also known as gatekeepers and advisors, who will act as advisors and consultants to the asset allocators or to the fund managers. The best way we could define theoretically private equity is investing through a negotiated process. And this has big implications because every private equity investment requires, in general, a negotiation with the management or the existing shareholders of a company, which is very different from the way a hedge fund manager or a manager of a mutual fund investing in quoted companies operates. And the second feature is that the investment strategy of the private equity fund manager is what's known as active. And so the PE manager is expected to play what's called an active role in his investment, and we're going to see what that really means. But the implication of that is that the skill set of the private equity fund manager is fundamentally different from the skill set of a mutual fund manager or a hedge fund manager. He needs to be a good negotiator and then know how to get involved in the company after investment. As we have seen, there are four subsets of private equity, these being venture, expansion, buyouts, and/or roll-ups, and mezzanine. And each of these has its own dynamics and a little bit its own ecosystem. Venture is connected to early startup companies, and these are young companies that need money to expand and a lot of support. Expansion refers to companies that require capital to expand, but somewhat less support of the management because there's already something of a management in place. So the way these are managed is somewhat different from venture. Whereas with buyouts, one of the key things to understand there is that the money invested doesn't go into the company so much, but more to buy out the existing shareholder. And so that's an important thing to notice, is that the value creation comes from changing the shareholder. And we'll see why that is. Mezzanine is a specialist part of private equity, and this refers to funds who like to make their investments through debt. And as we might expect, if an investment is made through debt, they have a somewhat less active role in the life of the company. There are a fair amount of statistics available about the size of the private equity market. We show here one from Invest Europe, formerly known as the European Venture Capital Association. They focus on European private equity, including Central and Eastern European private equity. But there will also be statistics from the North American equivalents of the Emerging Markets Private Equity Association and others, which are easily found on Google. So this gives you a bit of a sense of the size of the flavor. The European market, for example, is very much a domestic market, but there's also a very important cross-border European investment reality. We show here a highlight or an example of some statistics. These are from Invest Europe, and they refer to Europe. If we look at 2018, for instance, we can see that about 59 billion was invested in buyouts, about 12 billion in expansion, and about 8 billion in venture capital. And so in terms of the size of amount of money involved, buyouts are by far the largest, but look at the number of companies involved. Venture capital, the 8 billion in venture capital went into 4,400 companies. The 12 billion in expansion went into 2,000 companies, and the rest into buyouts went into 1,200 companies. So one of the characteristics of the market is the buyout part of the market is the largest by volume, but the venture part of the market is by far the largest by number of companies which have received an investment. And that's why the importance of venture and expansion in terms of job creation is much higher than in the case of buyouts. Some of the global trends we've seen emerging is firstly, the P market did fall substantially during the 2008 crisis, like many other asset markets. It went from 500 billion a year to more of a 250 billion a year market, so it has been reset. It is much more difficult to raise funds, particularly for new fund managers, than it used to be 20 years ago, and that also points a little bit to the maturity and the consolidation of the market. We've seen the emergence of the secondaries market, which is where new players would help investors in PE funds to get out of their investment, because one of the characteristics of private equity investment is that it's once you're committed to a private equity fund, it's very difficult to get out. The emerging markets have benefited from the continued growth of private equity, and that is also something that's correlated to their growth of their economies. What we've seen in the last 10-15 years is more and more specialization, particularly in the developed markets, where funds were specialized by region, by sector, or by stage of investment. We're also beginning to see some specialization in the emerging markets as well, although that still has some way to go. And we're also seeing a little bit of differentiation between an emerging market and a frontier market. An emerging market could be South Africa, a frontier market could be Burkina Faso, for example. One of the things to be familiar with in private equity as soon as possible is what are the performance measures, because obviously investors invest in private equity in order to earn a profit, a return. And how is this return measured? It's measured using most commonly what's known as the IRR, the internal rate of return, which is a percentage figure which expresses the annual return of private equity investment. The other measures we may have is distributions to paid-in capital, which means if you're an investor in a fund and you put in 100 and you've received 80 back, the distribution to paid-in capital is 0.8. The residual value to paid-in capital is what's still in the portfolio that hasn't been sold yet, divided by your capital, and the total value to paid-in capital is the arithmetic sum of the first two. When we talk about IRR, we also have to make a distinction between the gross IRR, which is the measure of the profit of the investment without taking into account the actual cost of the fund manager to the investors. And that measures the performance of the investment. The net IRR is calculated after you deduct the cost of the fund manager to the investors, so the management fees and the carried interest and other costs, and that represents what the investors in the fund will actually receive, and that is known as the net IRR. We take here one example. There's many others that are similar to it, and we've taken here the European returns as of the end of 2013. And if we look at the statistic for all private equity, you see that the return is 9.24%. But what is important to look here is what's going on underneath. And we talked earlier about the dispersion of returns. And if you look at it, the statistics have been broken down on the right-hand side of the slide between the top quarter fund managers, the second quarter fund managers, the third quarter fund managers, and the bottom quarter fund managers. They're known as the quartiles. So you can see that in this case, the top quarter of the fund managers returned 21%, which is a fantastic return for anybody on an annual basis, and the bottom quartile fund managers did much, much worse. So all these performance statistics have often been broken down into quartiles so that you're able to better assess who is good and who isn't. So looking at the numbers in the previous slide, what does it mean? Well, we can see that the average return is quite good in that particular year, and 2013 it was 9%. Typically it's been more in the range of 12%. It will vary according to the economic cycle, but it's typically around 12%. It depends if you measure in dollars or in euros, which market you're referring to, but something like the low teens has been a consistent return, which is quite good. And what we can see from that specific slide is we see the top quartile fund manager have done 21%. Now 21% on an annual basis is very, very good. The bottom quartile had -%. So if we look at these numbers, we can see that the difference between a very good fund manager and a really poor fund manager is 30% a year, which is enormous. And so hence the importance of understanding who is a good fund manager and who is not, because if you can back a good fund manager, you can do very well as an investor. Private equity funds can specialize in 6 broad ways. They can specialize firstly by type of financial instrument which they like to use. So some funds might just use ordinary shares or preferred shares or mezzanine or some combination of these. So the type of financial instrument through which they make their investment is one variable. The second way they can specialize is through stage. A venture fund may only target early stage companies. An expansion fund would target middle range companies. A buyout fund would only target large mature companies. So the stage of the company's life is another area where there could be specialization. Thirdly, it could be by sector. It's quite common in private equity to find a certain number of sector specialist funds. I think this accounts for maybe 10 to 20% of all private equity funds. So private equity funds do remain generalist by sector, but it's quite frequent to see agribusiness funds, telecoms funds, financial service funds, food industry funds, and a couple of others. Region and country. Most funds will have a geographical remit. Typically you'll see a country fund or perhaps some kind of a regional fund specializing in, for example, North Africa or perhaps Southern Europe. Another area where they can specialize is in the type of situation in which they invest. In Central Europe, we've seen many privatization funds who would invest in companies being privatized. In the US, we could see pre-IPO funds. So they will target companies that are just a year or two ahead of doing their IPO and fund these companies and then get out during the IPO. We've seen funds that specialize in succession problems, so targeting family companies where there's a problem with succession and there's no new generation to take over. And then finally, by return objectives. And this refers to impact funds, where some funds will not just target to have the maximum possible financial return, but they'll also try and have some kind of social objectives as well. We're able to subdivide private equity into 4 sub-asset classes, and why do we do so? Because each of these 4 classes has its own, let's say, dynamic, its own ecosystem, its own way of doing investments, which they share, which each subclass shares. So there are some differences between doing venture, expansion, buyout, and mezzanine investments. And it turns out that the sub-skills are somewhat different. Each one has its own slightly different industry associations and its own ecosystem. And so it's fairly logical to see in most markets that the PE market will be subdivided into these four subclasses, although in emerging markets and other markets where private equity is at an earlier stage, it is also quite common to see funds doing all four of these together. We can make a logical connection between the types of funds and the life cycle of the company, but it should be pointed out that there is a lot of overlap. So a venture fund will tend to be investing in the early stage of a company, although we can divide venture into two subcategories, which is early stage venture or seed capital and late stage venture. Expansion funds will refer to the point of the company's growth where it's still in a high growth phase, as evidenced by the red chart. So expansion funds will take the company when it's come out of being a venture into its higher growth phase, and then the buyout funds will invest in the company normally when it doesn't need so much capital for growth, so when it's reached a certain steady state, if you will. And funds that specialize in turnarounds, which we're not going to cover so much in this course, would be targeting companies that may be into some sort of difficulty. And then the mezzanine funds will operate somewhere between the middle of the expansion phase through to the beginning of the decline phase.
Question 2. Which characteristics best describes the venture stage of investment? A. Finance the growth and expansion of a company. B. Target acquisition of a business for major stake or control. C. Combination of debt and equity interest. D. Seed stage, finance the concept prior to startup.
Let's now look in a little bit more detail at the different subcategories of private equity funds and try and understand how they operate in terms of the way they look for investments, make investments, and manage those investments. Starting with the venture capital ecosystem. In this case, the venture capitalist is looking for a wide variety of companies. There'll be a lot of companies out there, small companies that people won't know about. They've got to be found. And so the venture capitalist needs to have a wide referral source because the pipeline market or the market of potential opportunities is quite fragmented. And what is the key factor they look for is the fact that the team presenting the venture will have some kind of a CV which convinces the venture capitalist that they are capable. The type of instruments used are going to be mostly shares. The companies cannot take debt. Preferred shares are going to be very common. The venture capital will be taking fairly significant stakes, and it's possible there'll be many rounds of financing, so-called seed, Series A, Series B, and Series C as they're known, and it's more difficult to value these companies. And typical deal size of a venture would be something like in the range of 1 to 5 million. How is the investment managed by the portfolio? Well, there's going to be a lot of emphasis on the company's internal operation because the company's still not formed. So the VC manager will spend a lot of time on human resources, helping them to acquire clients, and there also need to be decisions for those companies in the portfolio that don't work very well, which will need to be written off. In terms of the returns they're expecting, well, the returns are going to be widely dispersed. In venture, you're going to have quite a few write-offs, and you're going to be hoping for that big hit that makes up for the write-offs. And the target returns are going to be very high because the venture capitalist portfolio has a significant survival risk. The profile of the team members in private equity are going to be with an emphasis on operating experience, so you'll find team members who are maybe former entrepreneurs who've decided to become VCs, or perhaps consultants or corporate executives. Now let's turn to the expansion ecosystem. So expansion capital, also known as growth capital, also known as development capital, now refers to mid-stage companies. And similar to, unlike venture, we have a wider variety of sectors because venture tends to focus on sectors where there is innovation going on and it's usually fairly limited. In expansion, it's a very wide variety of sectors and also traditional sectors. And one thing the company needs is that it needs to be scaled up. And again, there are quite a few potential targets out there, and so there'll be more involvement in referrals by investment bankers and other middlemen. And the key factor here is is this management team or is this entrepreneur able to manage the company's growth to a higher level? Are they able to delegate? Are they able to allow a bigger, stronger team to be formed? The type of instruments being deployed are also going to be ordinary or preferred shares in mid-sized stakes. And here we may also see the beginning of leverage. Typically an expansion investment, the private equity fund manager may put in some leverage into the company a few years after he's made his investment to fund another stage of expansion, for example. And the deal size is typically larger, in the 5 to 20 million euros per deal. The focus in managing the company is to support the management and help them grow the company. And a big part of this may be so-called bolt-on acquisitions, where the company will buy a smaller competitor in order to grow more quickly. What we're looking for in an expansion portfolio is consistency. Unlike the venture portfolio where you have write-offs and a big hit, the expansion fund manager is looking for consistency, so no disasters in exchange for nothing that will become the next Skype. So a good, solid, consistent portfolio. And the profile of the team now will be a mix between financial experts and operating experience, which can include operating managers, investment bankers, and others. Turning finally to the buyout ecosystem. Well, the deal sourcing is completely different because these are big, large companies. They're well known. Everybody knows they're there. So it's more a question of tracking these companies and waiting to see if these companies will potentially be acquirable because of some event that has happened to the company. So it's not a question of discovering an unknown company. It's a question of following companies and waiting for circumstances to be such that the company may be, as some people put it, in play. The instruments will be more complex because buyout funds like to borrow money to buy the companies as well as putting their own money, and so the financial structures will be more complex, and the valuation will use DCF models and relative metrics. The typical deal size of a buyout will be 50 million plus. The portfolio manager is different because we have a management in place. It may not be a good management, but we have a developed management in place. And so the focus is really on reorganizing management, reducing costs, and in the case of the large funds, the fund manager may use outsourced assistants such as non-executive board members, independent board members, or consultants. And the emphasis here is on financial engineering and restructuring. The returns of these kinds of investments will depend very much upon the cycle and upon the leverage. If the fund manager is able to put leverage in, he'll get a very good return, and if they're able to get an exit at the right moment, they'll get a more attractive return. And the profile of the team is somewhat more on financial expertise, or on being a financial expert, on having strong business networks. Finally, the mezzanine ecosystem. Well, we're talking about companies which are later in their expansion or mature companies. It will share with expansion a wide variety of potential sectors. Often the mezzanine manager will work with an equity house, perhaps piggybacking their work. And the key factor the mezzanine manager looks for is where the company has enough cash flows to service the debt in some fashion with some flexibility. The type of financial instrument used is now subordinated debt with some call options or equity warrants for a small percentage of the company. The mezzanine manager doesn't participate so much in the company decisions. They may have a board seat, they may not. They would generally look for regular reports from the company and the fact the company would have reasonable corporate governance in place, such as audited accounts. The exits of the mezzanine fund, the target returns are going to be lower because they're taking less risk, and their target returns is typically between 15 and 20%. And the profile of the mezzanine team is very much a kind of financial profile. Let's now turn for a moment to the mechanics of private equity. And this slide describes what's called the investment cycle in private equity. So how private equity investments work over their lifetime. It starts with finding an investment. Once you've found an investment, you have to make the investment. Once you've made the investment, you have to manage it. And after a few years, you have to exit the investment. So there's 4 broad steps, obviously with very different timelines, but each one requires a certain skill level And for each of the four types, the skill level is a little bit different. One of the expressions we use that is used by Advent International, for example, was a fund manager could be a finder, a grinder, or a minder. The finder goes out in the community and networks and finds potential investments. The grinder makes the investment. That is a technical and negotiating kind of approach. There has to be a valuation made, a deal has to be structured, negotiations have to be conducted. Then after that's been done, the portfolio needs to be managed. So the company has to be improved. Somebody has to sit on the board of the company and help the company to move forwards. Then finally, exiting the investment. Well, this is the ultimate objective of PE fund manager. So the exiting of the investment is the final stage of the holding of the company, but it should also inform everything else that's going on in the years before that.
Question 3. What is a target deal size and return for a venture investment? A. 5 to 20 million and mid-range target returns 20 to 30%. B. 50 million up to mega deals and mid-range target returns 20 to 30%. C. 1 to 5 million and target returns 40 to 60%. D. 5 to 20 million and target returns 20%.
We will now examine the screening process of private equity investors. In other words, once a potential investment has been identified and found, how they will analyze it in order to make a decision to go forwards to negotiations. It's important to understand from the point of view of a PE manager how he can potentially originate his investments. And there's really 5 ways. One is that he just receives an approach which is unsolicited. And this problem with this is that there's a lack of selectivity. Another approach is that another investor contacts him and invites him to co-invest. And this is quite attractive and very commonly done by PE fund managers. The third way is that a broker or an intermediary brings him a potential deal. The fourth way is that the fund manager goes and does it himself and uses his own proactive energy to find investments. And lastly is if the PE fund is part of a wider group, like a banking group or a larger asset management group, the potential opportunities may come from within the group. So these are the 5 ways in which a fund manager may look for his deals, and some of them will just do it according to 2 or 3 of these ways. And it's important to understand their approach to origination. Once a deal has been found and we get to the screening process, the ultimate successful outcome of a screening process is a term sheet, a preliminary agreement, and we're going to discuss those later in the course. There's 4 components that will go into it. There'll be an initial meeting, an initial negotiation with the company and its management. There'll be some preliminary investigations called pre-due diligence. There'll be some financial analysis where the fund manager will have a look at the company's accounts and maybe do some rough forecasts. And fourthly, there'll be a consideration whether, if this investment is made, is there a way for the fund manager to actually exit that investment down the road. Here we consider in a bit more detail the screening process. And so we've broken it into 5 categories. So initial negotiations, what's important here is to see if there's a potential deal there and agree the general terms with the entrepreneur or the management of the company. Pre-due diligence really means we're trying to see if there's some obvious red flags or skeletons in the cupboard, and we're trying to figure out what kind of structured due diligence we need to do later down the road. The financial analysis, we want to have a quick look at the accounts and see what the real situation of the company is and what its potential forecasts performance could be. Exit strategy, we have to think about the sector in which the company operates and think about what the best exit strategy might be down the road, even if it's just a general intention. And the final deliverable should be a term sheet which will incorporate these 4 processes in it. Now, private equity funds are quite selective, and many entrepreneurs do sometimes get concerned that they don't get the attention they need. Now, part of the explanation for this is that screening investment in a professional and thorough way is very labor intensive. It can take quite some time One study by Bain and Co. estimated it's about 160 man hours to do a thorough screening. And so investors will be very selective as to which kind of companies they want to go in and screen in a little bit more detail. And some of them will make use of checklists. These are lists that each firm will develop, which they will go through. And this will also help the more junior members of the firm who may not have the same level of judgment as the more senior members, but the checklist will allow them to go through and decide whether this company is worth investigating further. Each company will be different, but it's possible to construct a rough profile for the investment criteria. So in the case of a venture, a company with no track record, what we're looking for is firstly the sector, that the sector be an interesting sector of innovation, and that the management have a prior track record from a previous position or life which would qualify them to take this company forwards. In terms of expansion capital, what we're looking for now is the ability of the management to manage change and acceleration. And the typical problem you might face here is an entrepreneur who is having difficulty getting the company to the next stage because of maybe he's not unable to delegate or is just generally suited for a smaller company. In terms of the buyout, what we're looking for here is the possibility to acquire the company at the right price and align the interests of management with those of the fund. In terms of restructuring, it generally involves changing the management team. Now, we've looked at it from the point of view of the PE manager. Now let's look a little bit about the underlying forces and realities which will make the conditions such that a company will be receptive to a private equity investment. Well, companies, we have to look at 2 points of view. One is the company itself and the company's needs, and one is the ownership of the company and what's motivating them. In terms of the forces that may drive the company to seek private equity investment, it may be growth. The company wishes to get additional resources to finance organic growth or to make an acquisition. It could be the company has too much debt and is looking for some more equity to reduce its debt burden. Or thirdly, it could be that the company feels that the ownership of its company is holding it back. Typical example of that may be a family-owned company where the family are in some kind of succession problem, or maybe a division of a conglomerate which no longer wishes to keep that division. And so the value is created from a change of ownership. The forces driving the ownership, it could be a positive motivation. So the owner has a vision that the company can grow. It could be a neutral motivation, such as the owner wants to have succession problems, wants to disengage, maybe because of health reasons or age reasons. Or it could be a negative motivation. The ownership is in distress because the owner himself has too many debts, or there's a conflict among owners, or the owner has decided that this particular company is not interesting for them anymore. And private equity can work with positive and also with negative motivation. In fact, some of the best deals can come from a negative driver. And the important thing to remember is that for a private equity deal to be feasible, we need to have the factors driving the company and driving the ownership to both be in place to facilitate a deal. So what are going to be the things one looks for when trying to find a potential private equity deal? From the point of view of the company, we're looking at potentially an attractive market, that the company has the possibility to have a good market share and develop a competitive advantage. When we're looking at the ownership dynamics, we're going to be looking at what is the concentration of ownership. Is it a fragmented ownership that could be kind of mopped up? Or it could be a family ownership where there may be some generational issues going on. It could be a succession problem, or it could be an ownership that's disinterested. So the dynamics of ownership are important, and that will lead to the deal dynamics. The deal dynamics will include the valuation of the company, the structure of the deal, how the management is going to work, and what the exit strategy will be. We can identify some typical profiles of situations that one does come across in the market, which will motivate the company and their owners to seek an investor. One is growth, which is the ambition of a company to accelerate its expansion. It could sometimes be that it could be a joint venture where an investor may want a private equity fund to co-invest with them to reduce the risk of their investment. It could be a fallen angel, a company which has a solid underlying business which has some financial problems or some commercial problems. It could be a distressed owner or a succession issue. The company is perfectly okay as a company, but there's a problem among the shareholders about valuation, about issues between them, about money or who's doing what, which can only be resolved through one of the shareholders exiting. It could also be a consolidation play where you buy a company and then you go and buy 3 or 4 of their competitors and build up a national champion. Or it could be regulation driven, like in the case of banks, the central bank orders a regional bank to sell its subsidiaries in one particular country, and that creates an opportunity. And so these are all profiles that will recur in many markets. In a similar way to the previous slide, we have certain profiles of typical entrepreneurs. We'll get in later into some details of how they behave. In some emerging markets, we have what could be described as early stage oligarchs, like you might have in Russia or Ukraine. We've also got later stage oligarchs, which are early stage oligarchs, which have become more sophisticated by introducing more corporate governance into their businesses. We also have smaller oligarchs who are often looking for partners because they're always worried about being bought out or taken over by larger oligarchs. We've also got diaspora members who are from an emerging market that have gone to the West to study or to work, and they want to come back. For example, very strong diasporas, for instance, in the Nigerian diaspora, the Armenian diaspora, the Lebanese diaspora, and these people will be kind of having one foot in the emerging market and one foot in the West. Another typical profile we get is multiple owner SMEs. This is typical of, say, a Silicon Valley company, and it's a company that will be set up by a group of university friends or former colleagues, so they are non-family related entrepreneurs. And the final model is the single owner SME, which corresponds, say, to Italian or German family companies, which are set up by a single founder who then takes the company forwards to the next generation. As well as typical profiles of entrepreneurs and profiles of situations that create private equity investment, we've also got the broader investment themes, which will be followed by private equity fund managers, particularly in emerging markets. One will be the so-called middle class play, which is consumer-driven industries. So as the country develops, more people join the middle class, and they will have needs of consumer-driven industries. Another example is the knowledge economy, which is to do with internet or technological innovation. Another investment theme is regional consolidation, where a fund may buy companies on a national basis and consolidate them regionally. Another investment theme is financial intermediation, where a fund will invest in financial institutions, which gives them a general exposure to the economy because, say, for example, the loan portfolio of a bank will be in many sectors. And another theme is infrastructure and power of energy. It's quite common to see private equity funds working in this area, particularly in the lower capital intensive part of it. If you're a private equity fund manager, you are going to be negotiating and dealing with entrepreneurs, and these are some of the characteristics that most entrepreneurs have in common. Firstly, they're good manipulators of people, because an entrepreneur, in order to build up his business, he needs to use other people. So they tend to be very good at making people do what they want. They're also clever, and they will try and work out what the investor would like to hear as a negotiating tactic, and then tell them what they would like to hear. As it's their own money, they're highly motivated. And so, if a bank is lending to them, that bank officer negotiating with the entrepreneur, it's not his money, he's not going to have the same level of motivation as an entrepreneur. Entrepreneurs also have alternatives they will not share, so they are creative negotiators. They do not mind cutting corners, so if it's not entirely legal, they may do it anyway. And if they are put into a corner, because it's their own money at stake, they will have maybe sometimes unpredictable behaviors. Let's now look at private equity from the point of view of the entrepreneur, because there is a lot of disinformation about private equity and misunderstandings, and these are some of them. Firstly, the entrepreneur thinks, well, private equity is a win-lose game. The fund is just trying to take my company away from me. The counter-argument to that is to make them understand that the private equity investor only makes money if the value of the company appreciates. And by providing the entrepreneur with some liquidity, he's also got the possibility to diversify assets. So these are some strong counter-arguments. The entrepreneur may think if valuation is the only criteria, it should be the highest possible valuation. The main issue there is that if things don't go as planned, it is difficult for an entrepreneur to have a significant minority shareholder who is not happy about the business. Another typical thing here of entrepreneurs is that private equity investors don't really add any value because they're not entrepreneurs like me, and they've now been in an operating role. Well, typically, private equity fund managers have had a previous career which is relevant, and that can add a lot of value. They can also see things that the managers of a smaller company cannot see because they've seen patterns over the years, and they may also have a network of relations, and this is very powerful. Taking private equity means you lose control of your company. Well, I think the key there is to make the private equity entrepreneur understand that we are trying to protect our position as a P manager rather than gain control by stealth, which is often the suspicion the entrepreneur will have, that these arrangements are some kind of Trojan horse. Finally, private equity investors are only really interested in exit. Well, clearly, private equity investors are looking to exit, but there can be some alternatives which allow the entrepreneur to stay on, such as an IPO or selling to another private equity fund.
Question 4. What are the necessary factors to be in place for a P deal to go ahead? A. Growth, financial and ownership. B. Positive motivation, neutral motivation and negative motivation of ownership. C. Early stage oligarchs, later stage oligarchs and smaller oligarchs.
Now let's try and put the financial perspective of private equity, so how the market dynamics operate that we've seen, the different types of sub-markets like venture and growth, the screening process that private equity investors use, and relate it to the company and where the company's advisor can help. So it's about financing your business, and like everywhere, the choice that anyone faces in financing the business is between internally generated cash flow, debt, and equity. So private equity is part of the equity component of this, and going through the business, doing an analytic of the business and understanding what financing is the right one for the business will help the company understand better whether it's really worthwhile to engage with private equity. And therefore, any financial advisor to the company, armed with the knowledge of how the PE market works, is in a better, more informed position to apply this knowledge to generating and analyzing the pros and cons of one of the options of equity financing for a business. Not only having access to finance, but being able to choose the most appropriate method of finance for your business can result in continued growth and profitability. A key requirement to ensuring you choose the right funding is to fully understand the differences between debt and equity and to consider the implications for your business. Debt, equity, or internal funds. All businesses need finance to start up operations and in order to grow. Finances can be provided from the following three sources. Debt, financing provided from an external source such as a bank. Equity, financing providing from an internal or external source such as an owner or an investor. Internal funds, profits and cash generated by the business which are used to fund the ongoing operations and expansion of the business. Deciding between debt and equity. In uncertain economic times, you may wish to reduce the financial risk of taking on significant debt funding. It may indeed also be difficult for you to raise debt finance, so that you may need to be prepared to share the ownership of your business to increase funding to the business. You may also consider a combination of debt and equity funding to meet the business requirements. Therefore, an investor must be there to be prepared to provide both equity and debt finance. The choice between debt and equity. Assess the limitations that debt finance may bring to your company. Match the right debt product and features with your business circumstances and requirements. Determine if your business has the growth potential to be attractive to an equity investor. Evaluate your willingness and/or preparedness for the changes equity investment will require. Your attitude to losing full control and power to make all decisions without consulting other owners has to be examined. The willingness to identify an appropriate exit strategy and its impact on you will also have to be considered.